Welcome to Dinar Shift. Today's news centers on a development that has captured the attention of financial analysts and currency observers around the world. Reports from multiple credible sources suggest that the Vietnamese Dong may have just experienced a major adjustment in its official exchange rate, a change that could mark one of the most significant financial stories of 2025. The implications of this move reach far beyond Vietnam's borders, sparking renewed discussion about how emerging market currencies evolve as economies mature and integrate more deeply into the global system. Across international trading platforms and within government monitoring circles, data is showing subtle yet notable shifts in the Dong's value. While the term revaluation is already being widely used online, experts caution that understanding the true meaning of this event requires careful analysis. What's happening now, according to reports from within Vietnam's financial sector, may be the first sign of a broader, long-term adjustment strategy rather than a single overnight policy change. For years, Vietnam has maintained a tightly controlled currency management system. The State Bank of Vietnam, which serves as the nation's central bank, operates under a framework known as a managed floating exchange rate. This means that instead of allowing the Dong to fluctuate freely based on market forces, the bank sets a reference rate each day and allows the currency to move within a predetermined percentage range above or below that mark. Historically, this range has been around 5%, helping protect Vietnam's economy from sudden currency shocks while supporting its export-driven industries. That structure has allowed Vietnam to maintain stability through periods of regional and global uncertainty. However, recent adjustments to the reference rate have fueled speculation that the central bank may be allowing a more organic strengthening of the Dong in response to Vietnam's rapid economic growth. Observers suggest this could be a calculated step toward aligning the nation's monetary policy with its growing influence in international trade, and finance. Current data indicates that the Dong is trading near 24,000 to the US dollar. Yet, certain regional banks and exchange platforms have begun displaying slightly stronger figures. These minor shifts, though seemingly small, have drawn significant attention because even fractions of a percent can indicate a change in monetary direction. Some traders believe Vietnam's authorities are testing how markets respond to a gradually appreciating Dong, while others see this as the beginning of a broader reform aimed at reflecting the country's rising economic strength. Vietnam's motivation for such a move can be traced to its impressive transformation over the past decade. The nation has become a manufacturing powerhouse, attracting substantial investment from multinational corporations based in the United States, Japan, South Korea, and across Europe. Its exports, ranging from electronics and textiles to machinery, have expanded rapidly, helping generate consistent trade surpluses. As foreign capital flows into Vietnam, market dynamics naturally apply upward pressure on the Dong's value, suggesting the time may be right for a carefully managed appreciation. Still, strengthening a currency carries complex consequences. A more valuable Dong can enhance purchasing power domestically, but it can also make Vietnamese exports more expensive to foreign buyers. This creates a delicate balance for policymakers, who must protect the competitiveness of key industries while maintaining long-term credibility in the international marketplace. A sudden dramatic revaluation could disrupt manufacturing operations and threaten jobs, which is why officials appear to favor a measured, step-by-step approach. According to economists monitoring these changes, this gradual pace is intentional. It allows the market to adjust slowly, providing time for exporters, importers, and investors to adapt. While today's fluctuations might look minor, the pattern suggests a strategic direction rather than random volatility. Vietnam's government has signaled its intention to maintain financial discipline while allowing its economic fundamentals to guide currency evolution. For context, a revaluation occurs when a nation's currency strengthens relative to others due to government or central bank policy changes. This differs from a devaluation, where a currency's value is intentionally lowered. The current trend appears to reflect the former, a possible move toward recognition of Vietnam's strong economic footing. Countries typically revalue their currencies when inflation is under control, reserves are healthy, and economic confidence is solid, all conditions Vietnam currently meets. Over the past year, Vietnam's GDP growth has outpaced that of many developing nations. Its foreign exchange reserves are among the largest in Southeast Asia, providing flexibility to support the Dong if market conditions become volatile. This financial strength allows the government to explore gradual reforms without risking instability. The combination of growth, investment inflows, and stable inflation makes the case for a controlled appreciation process more credible than at any point in recent history. Experts emphasize that dramatic overnight changes, such as those rumored in online discussions, are extremely unlikely in modern financial systems. Central banks typically avoid such moves to prevent disruptions in trade, banking, and public confidence. What Vietnam appears to be doing instead is expanding the daily fluctuation band slightly, allowing the currency to strengthen incrementally in a way that mirrors broader economic progress. Three main factors are expected to influence how this development unfolds. The first is GDP performance. Continued annual growth near or above 6% will maintain upward pressure on the currency. The second is foreign investment, which continues to rise as global manufacturers seek alternatives to China for production and supply chain diversification. The third is export demand. As long as global consumption remains steady, Vietnam's trade surplus will keep reinforcing its financial stability. The regional environment also plays a major role. Neighboring nations like China, Thailand, and Indonesia have all adjusted their monetary policies recently to address global market shifts. Vietnam must navigate these changes carefully to avoid pricing itself out of regional competitiveness. If nearby currencies weaken while the dong rises too quickly, exporters could face challenges, which is why the state bank's cautious approach is so critical. From a structural perspective, the state bank's communication strategy also appears to be evolving. Recent public statements have stressed the importance of flexibility and alignment with international markets, language that often precedes gradual currency liberalization. Economists interpret this as preparation for a long-term policy shift that could bring Vietnam closer to the practices of advanced economies. Another important factor is Vietnam's growing foreign reserve position. These reserves serve as a financial safety net, enabling the government to stabilize the dong if necessary while pursuing controlled appreciation. This accumulation of reserves, fueled by trade surpluses and foreign investment, gives Vietnam's financial authorities the confidence to test the currency's strength without risking instability. For everyday citizens, the immediate effects of a stronger dong may appear modest. Travelers exchanging foreign currency could notice slightly improved rates, while importers may see reduced costs for certain goods. However, the broader implication is symbolic. A stronger currency reflects confidence, maturity, and global credibility. For Vietnam, this marks another milestone in its transformation from an emerging economy into a regional powerhouse. That said, potential risks remain. If appreciation moves too quickly, exporters may face reduced international demand, and manufacturing employment could decline. Inflation patterns might also shift as import prices adjust. The State Bank of Vietnam is expected to monitor these dynamics closely, intervening when necessary to keep the economy on a steady growth path. Financial analysts largely agree that the most probable outcome is a sustained, gradual strengthening rather than a sudden revaluation. This approach allows the country to build investor confidence over time while safeguarding its export-driven industries. Some experts even predict that the dong could continue to appreciate modestly over several years as part of a larger reform process designed to modernize Vietnam's financial infrastructure. For global observers, this development reinforces Vietnam's growing importance within Asia's economic landscape. Its balanced policy approach, prioritizing stability while embracing modernization, positions it as a model for other emerging markets. As the nation continues its transition from manufacturing dependency toward greater domestic consumption, a more valuable dong could also support higher living standards and consumer purchasing power. In conclusion, the latest reports from Vietnam indicate a carefully managed currency adjustment that reflects the country's expanding economic strength. While it's too early to define this as a full-scale revaluation, the signals suggest meaningful progress toward greater financial independence and international credibility. For now, all eyes remain on the State Bank of Vietnam as it continues to fine-tune its policies. The Vietnamese Dong story in 2025 is far from over. What began as a modest adjustment may well evolve into one of the most defining financial transitions in Southeast Asia. As always, Dinar Shift will continue to monitor this development and bring you factual, balanced updates as new information becomes available. Stay tuned, stay informed, and thank you for watching. In conclusion, the latest reports from Vietnam indicate a carefully managed currency adjustment that reflects the country's expanding economic strength. While it's too early to define this as a full-scale revaluation, the signals suggest meaningful progress toward greater financial independence and international credibility. For now, all eyes remain on the State Bank of Vietnam as it continues to fine-tune its policies. The Vietnamese Dong story in 2025 is far from over. What began as a modest adjustment may well evolve into one of the most defining financial transitions in Southeast Asia. As always, Dinar Shift will continue to monitor this development and bring you factual, balanced updates as new information becomes available. Stay tuned, stay informed, and thank you for watching.